All right, now it's recording. That way I can post this later on Blackboard and you guys can view it. I'm actually going to just stop my video now because I don't think it's not really needed at this point. My camera's up there, but I'm going to be looking at my screen the whole time, so you're just going to see the top of my head anyway. So I'm just going to stop the video right now in terms of my camera. And I'm going to share my screen. And let's just start as we would in the normal lecture with the PowerPoint presentation. So chapter 7. And I'll just say a few things. I'll try to add what I can add, and if it's just a slide that you can read on your own, I'll tell you that. So this chapter is about internal control, and in particular, internal control and safeguarding cash. So the first thing we have, we learned what fraud is and the 3 elements of the fraud triangle. So fraud is pretty self-explanatory. Basically, it involves an employee of a company trying to steal from the company. So embezzlement of cash, embezzlement is just another word for theft or stealing inventory or any of the assets. It could be a little more involved than just stealing. It could be filing false insurance claims. I mean, that's essentially a stealing, but in a more sophisticated manner. And then financial statement fraud is also falls under the category of fraud. And this is where a company, reports wrong numbers. So they're reporting that their net income is higher than it really is. They're reporting that their assets are of higher value than they really are, or they're reporting that their liabilities are lower than they really are, make themselves look better to investors. Hopefully more people will buy their stock, things of that nature. So if you just joined, please mute your mic. I can hear the background noise. And if you have a question, you can go to the bottom of your screen and to the chat icon where it says chat, and you can type in there, say I have a question, then you can unmute your mic and ask your question if you've just joined. I'm sharing my screen right now. You should see my screen if you just joined. We're just going through the PowerPoint presentation. Fraud is a punishable crime. Fraud is known as white-collar crime. It's not a blue-collar crime like murder, things of that nature, but it does hurt people. Stealing money can really seriously hurt people. So it is punishable. The fraud triangle consists of three things, and without any of these 3 things, so if one of these 3 is missing, then fraud can't happen. So we have pressure, rationalization, and opportunity. Individuals will feel pressure. To give an example, take a single mother who's been working for 20 years at a company. She feels she's underpaid. She has financial pressure, to pay the bills at home. So she decides to embezzle money. So the pressure is, you can see the pressure. She has an opportunity, say she's in charge of, custody and record keeping for, say, cash, which is a bad thing. We'll talk about that later. You want to segregate duties. You don't want one person in charge of 2 different things. So she has the pressure, she has the opportunity, and then she'll rationalize it by saying, I need the money more than the company does. I'm a single mother. It doesn't matter that I stole from the company. So these are actually real cases. That's a real example that's happened before. And some people, they have the pressure, their opportunity, and they feel like they have a pretty good rationalization, and they really don't think that they did anything wrong. So the pressure and then the rationalization is just, some justification for why you did it. And then you have to have the opportunity. a chance to get away with it. If there's no chance to commit fraud and get away with it, then fraud can't happen. So what companies will, their whole system of internal control is designed mainly to limit the third element of the fraud triangle, the opportunity. I mean, they can't control employees' rationalizations, and to some extent, they don't have much control over pressure if it's, from the employee's outside environment. If it's pressure within the company, they can control that. But if it's, the single mother, she has this pressure to pay the bills, she's got kids, the company can't control that. That's her own pressure. So to limit fraud, companies mainly try to limit this third element of the fraud triangle. They have the most control over that, the opportunity. They can mitigate the opportunity that employees will be able to commit fraud and get away with it by implementing certain internal control procedures, and we'll talk about that here. So discuss how the COSO framework helps prevent fraud. COSO, what's COSO? COSO stands for Committee of Sponsoring Organizations. And let's go to Wikipedia really quickly. And I think I have COSO open up here. So COSO, Committee of Sponsoring Organizations of the Treadway Commission. So what happened is in 1985, 5 major organizations, and you can see them here: the Institute of Management Accountants, the American Accounting Association, the AICPA, the American Institute of Certified Public Accountants, and so forth. 5 institutions decided to come together and sponsor the National Fraudulent Financial Information Commission. And they funded this. And the original president was James C. Treadway, and that's why they nicknamed it the Treadway Commission. And this commission came about as a result of the U.S. Congress passing, based on the United States Securities and Exchange Commission, the SEC, based on their findings, Congress passed the Foreign Corrupt Practices Act of 1977. That was an attempt to crack down on transnational bribery, and it required companies to implement internal control programs. And so in response to this Treadway Commission was formed, and basically the COSO, they studied financial information systems at companies using a sample of publicly traded companies from 1985 to 1987. And they published a report in 1992. And that report was titled Internal Control, an Integrated Framework. And that's what most companies use, that framework today, in establishing their internal controls. And most accounting textbooks cite that report and that framework. They updated that framework in, I think it says here, in 2006. In the 2000s, they updated it, or maybe 2013. But anyway, I just wanted to go here so you could get a background on what COSO was. They're the sort of the commission, the group of people that were funded by these 5 major institutes. And they developed sort of the Bible, if you will, of how companies should set up internal controls. So going forward, what are internal controls? Go back here. They're just procedures or measures undertaken by a company to ensure the reliability of the accounting data, the reliability of the financial statements, and ensure that employees are following policies and procedures. They are implemented to reduce the likelihood of errors, to catch any errors that may occur, to prevent fraud, essentially. So this framework that came about in this report that COSO made in 1992, they have this framework. So they take, you can view it like a cube. But the important part is just the two dimensions here, on top and on the front. So they take a company and they say that anything within the company can fall into either compliance activity, operations activity, or financial reporting activity. And each of these activities within the company should have 5 internal control components: control environment, risk assessment, control activities, information and communications, and monitoring. For the exam, you just need to know what these 5 internal control components are, and know what each one of them, you know the 5 and then know what each one is. The control environment, it sets the tone for the organization. It includes management philosophy and style, assignment of authority, responsibility within a given, you have a company and then you have different divisions, and each division has a manager, and underneath the manager there's vice managers or sub managers, and then underneath them it establishes the the flow of command. It should have a process for attracting and developing competent employees. Companies have background check for new hires. They recruit. They're supposed to be unbiased. Companies they're supposed to accept applications from any sex, any race, things of that nature. There should be a reward system. So what companies usually do for their new hires is they have an employee handbook, a new employee handbook, and all the employees are supposed to read that handbook. And in that handbook, that's where they set forth these things about the control environment. There should be some sort of risk assessment in place. Risk is the possibility that an event will occur that will have a negative impact on the company. Risk assessment involves identifying and analyzing risks that the company deems relevant. And it is an ongoing process. You never just stop. Control activities. Control activities, this is the part of the COSO framework that we're going to talk about the most in this chapter. So control activities are the specific policies and procedures that the business implements to reduce risk. Reduce risk of what? Mainly to reduce the risk that the company's employees will steal from them. Reduce the risk of fraud, mainly. These control activities can be either a preventive control or detective control. Preventive controls are intended to stop the problem or prevent the problem from happening before it happens, whereas detective controls are designed to uncover the problem after it's already happened. Obviously, preventive controls are more desirable than detective controls because it's almost always less expensive to prevent a problem than to, once you have a problem, uncover it and solve it. So companies will spend more money on designing preventive controls because they save the company more money in the long run. So along with the control activities, what are some preventive and detective controls that could be implemented? Establishing clear lines of authority and responsibility, implementing segregation of duties, and we'll talk about that. Segregation of duties is where you don't have one employee performing, multiple functions. And we'll talk about what those functions are. I mean, one employee can do multiple things, that's fine, but it has to be within fall under one function. You want to separate duties. Obviously, hiring competent personnel. Using control numbers on all business documents. So for example, checks that the business has, the check should have a check number on it, No two checks have the same number. There's sequential control numbers on documents. This helps to prevent fraud. Develop plans and budgets, maintain adequate accounting records, provide physical and electronic controls, and so forth. You can read this right here. This is pretty self-explanatory. Segregation of duties. And so, what duties should we segregate? Mainly, what you want to separate are the functions of authorization, recording, and custody. You don't want one employee having the ability or having the authority to authorize a transaction and then make the journal entry for the transaction, record it, and also have custody of the assets. You want to separate these duties. If you have one person doing all three of these or even two of these, there's more likely fraud can happen. There's more of an opportunity for fraud. For example, if I have custody of, I'm the one that gets the cash that comes in, that's mailed in, and I also have recording duties. So I record what I get. Obviously, I can record that I got less than what I really got, right? Say I get $300, I could debit cash for $250, credit the customer's account receivable, or I could debit cash for $300, credit the customer's account receivable for $300. So the customer's happy, their account receivable is satisfied, and then I could pocket 50 of the 300 myself and cover it up. It's easier to cover it up. But if I don't have both of those duties, if I don't get to both record and have custody of the cash, I can't. It's much harder for me to do that. The only way to get to commit fraud then, if you segregate duties, is you have to have collusion. You have to have, collusion is cooperation of two or more employees together to commit the fraud. So I'd have to, my best friend is doing the recording and I'd have the custody. Then we could, collude together and commit the fraud. But it's harder to commit fraud when you segregate duties. It requires collusion. You can read this. Control numbers are important. All business documents like checks, sales invoices, purchase orders, they should be pre-numbered so that any missing document is easy to spot. So that's the point of numbering things. Missing documents are easy to spot, identify. It's easier, a paper trail is what they call it. You can read that, pretty self-explanatory. I want to get to the main parts that I want to talk about here. I'm just going to keep going through this. So companies, obviously a company is required to be audited by a public accounting firm. That's not an internal audit, that's an external audit. That's required every year or every accounting period. If the company is releasing public financial statements to investors, those statements have to be audited by an external auditor. But also within the company, a company also has to have an internal audit team. These are employees of the company, and they are supposed to monitor the various activities that happen. So the internal audit function provides appraisals of a company's internal controls and financial records. Their main job is to determine if adequate controls are in place, and they would be the ones to design certain controls. If they feel like, say that there's no segregation of duties, they would be the ones hopefully to implement segregation of duties. All right, the internal control that requires no one individual is assigned too much responsibility. And that's B, segregation of duties. You don't want one person doing multiple functions. All right. Control failures. Obviously locks company locks its warehouse. That's a control feature. If the employee forgets to lock the door, that's a control failure. I talked about collusion. Um, the company might be trying to do their best in terms of limiting um, fraud. They have, segregation of duties. But then if they have, two employees who are doing different duties, but they're best friends and they decide to collude, that can circumvent the internal control of segregation of duties. The best approach is to hire high quality employees, do background checks so you know that they don't have previous criminal record, pay them adequately, and try to maintain as ethical environment as possible. And that of course starts at the top. The tone at the top sets everything. You can just in general feel as an employee when you go to work for a company if they're an ethical company or not, right? Your first inclination will come from, when you read the new employee handbook. Then it'll come from your direct supervisor. You can just tell, if they're a little lax, they bend the rules, then you're probably going to bend the rules, or you're going to at least, be introduced to this. Hey, this company, they'll bend the rules a little bit. But if your supervisor is, straight by the book, and that tone is sent down from all levels of the organization. So all supervisors, even to the very top, are sending that same message down to their subordinates. Then it's less likely fraud will happen at a company like that. Doesn't mean it won't happen, it just means it's less likely. Companies can purchase insurance. Excuse me. Companies can purchase insurance to, in case, their internal controls fail and some fraud happens and the company is in, some employee steals money from the company, company can have insurance against that. You can purchase insurance for anything nowadays, right? You should know what the Sarbanes-Oxley Act was, abbreviated SOX. 2002, Congress passed an act. Two senators, Paul Sarbanes and Harold Oxley, they came together and wrote up this act. That's why it's called the Sarbanes-Oxley Act. And Congress passed it into law. It's essentially legislation that makes it a law that public companies have to maintain an adequate system of internal controls, and external auditors. After the Sarbanes-Oxley Act, external auditors not only audit the financial statements, but they audit the internal controls of the company. And they have to give an opinion on both. Previous to the Sarbanes-Oxley Act, the external auditor only had to give their opinion on the financial statements. After the Sarbanes-Oxley Act, the external auditors have to give their opinion on the internal controls as well. Also, what came about as a result of the Sarbanes-Oxley Act is more extreme punishment for CEOs of companies who are found to defraud, commit financial statement fraud. So like Enron and WorldCom, these were major examples of corporate fraud, financial statement fraud, and that's one reason why the Sarbanes-Oxley Act was passed right after all of that. But take the Enron CEO, for example. Pre-Sarbanes-Oxley Act, a CEO did not have to, publicly certify or formally certify that their financial statements, to the best of their knowledge, faithfully represent the underlying events that happened. They didn't have to sign. After the Sarbanes-Oxley Act, CEOs have to put their signature there so that if later the company is found to have defrauded, so their financial statements were found to be fraudulent, the CEO can be held personally liable in a court of law and can be sued and things of that nature. Also, as a result of the SOX Act, the penalty, if the CEO or the CFO or any of the employees are found guilty of fraud, the penalty for that is much higher. You can be given a prison sentence up to 25 years, whereas before SOX, the penalties weren't there wasn't formal penalty like that. But after SOX, it establishes these formal penalties. So all in all, the Sarbanes-Oxley Act, I believe, has had its intended effect. It's reduced corporate fraud across the board. Of course, we don't know the counterfactual, right? We don't know what would have happened after SOX, or what would have happened after 2002 in terms of corporate fraud if SOX wasn't passed, because it was passed. We don't know what would have happened. But I believe that SOX, because of just some of the prescriptions that it has in it, is definitely helping to limit fraud. All right. In this chapter, the main focus in terms of on the exam is going to be understanding companies' internal controls over cash. Why cash? Cash is the most liquid asset. It's the easiest asset to steal, right? That's why. That's why we're going to talk more, put such a focus on internal control over cash. What is cash? Cash includes coins, currency, obviously. Checks are counted as cash. Money orders, checking accounts, savings accounts. On the balance sheet, you rarely just see cash. You see the heading cash and cash equivalents most often. So cash is combined with cash equivalents. What's a cash equivalent? Cash equivalent is something like a CD, a treasury bill, or a money market account. So the formal definition of a cash equivalent is, I guess if you want to use the terminology, it's an investment that is 90 days or less. So it's either cash or it's something that can be turned into cash within 90 days, like a short-term CD, like a 90-day CD, a 90-day treasury bill, or so forth. The accounting rules, GAAP, they treat a 90-day treasury bill the same as actual physical cash. Cash that is restricted in its use must be reported separately. Don't worry about that. If there's some part of cash the company is restricting, that we're going to use this only for this, then that has to be reported separately on the financial statements. But don't worry about that for the exam. All right, internal controls for cash. Because cash is so easily taken, concealed, or otherwise misappropriated, most companies have developed elaborate internal controls to safeguard their cash, and we're going to talk about that. Controls for cash involve a mailroom or retail sales area for receipt. The treasurer is the one who has custody, and the controller is the one who is in charge of recording. And then internal audit comes in and investigates to make sure things are going okay. So I want to go to the book now, because I believe the book does a much better job of just the PowerPoints themselves. So in chapter 7, exhibit 7.1 and exhibit 7.2 are really important to understand. So we have internal controls for cash received on account. So customers are mailing in cash or checks and to pay off their account, right? And so exhibit 7.1 illustrates the whole internal control system that companies put in place to safeguard cash that's being received on account. So we have that. And then in exhibit 7.2, where you have a retail sales area, like at Walmart, customers are paying cash right there at the cash register, and we got to have some internal controls in place to ensure that cash is not misappropriated in that setting. So we have cash received on account, and then cash in a retail sales environment. Internal controls over both of those. So for the cash received on account, the first internal control a company has in place is a mailroom. So they'll set up a separate post office box, and they request that customers mail their cash payments on account to that post office box. All other mail and company correspondence would be directed to another company address. So there's one post office box just for cash for customers to pay off their accounts. All right, so what do the mailroom employees do? Obviously, they open the envelopes that contain the cash or the checks. Cash means cash, currency, coins, or checks. So the word cash means that. They open the envelopes that contain the cash, and each envelope would likely contain a check and a remittance advice. A remittance advice is an advice the company sends to the customer that informs the customer. It has the customer's name, the amount that the customer owes, and it has their account number. And so the customer will fill that out along with fill out the check and send both of those to the company. So the mailroom employees need to ensure that the dollar amount on the check and the dollar amount on the remittance advice, what the customer owes, are the same, right? The customer is paying off their account, so the check should be for the same amount as what they owe. Mailroom employees will ensure that, and then they'll place the checks in one pile and the remittance advices in another pile. The mailroom employees will endorse the check and say for deposit only, which means no one can cash it, it can only be deposited. You can already see the controls here in place. The mailroom employee will also prepare a remittance list. A remittance list is just a summary of all the remittance. It's a summary of all the checks received. So for each check, the remittance list will include the customer name and/or account number, the check number, and the amount of the check. And then a separate mailroom employee will compare the remittance list, which is just a summary of all the checks. It'll compare that to the remittance advices, which is what all the checks should have been for, and can make sure that those lists agree with each other. And then the mailroom will send the checks to the treasurer's department and the remittance list and the remittance advices to the controller's department. So the physical custody of the asset, the physical custody of cash, is the treasurer's department. And the recording is done by the controller's department. So you can already see the control here that's in place. Once the treasurer gets the checks, they prepare a deposit slip. The deposit slip is just, whenever you go to deposit money, deposit a check in your bank, you go up to the teller, you have to fill out a deposit slip, right? So basically that's what the treasurer is doing. They fill out the deposit slip, which details what the total is that they're depositing into their company's bank account. And then they'll send the deposit slip and the check to the bank, and all the checks to the bank. And they'll send a copy of the deposit slip to the controller. And then they'll keep a copy of the deposit slip for themselves. So that's what the treasurer does. The treasurer doesn't make any journal entries or record anything. All they do is just take the checks, make a deposit slip, and send the checks and the deposit slip to the bank and a copy of the deposit slip to the controller. The controller, they never get to actually get they never get the checks or the cash. They don't have any custody duties. All they're in charge of is recording. So what they do is they get the deposit slip from the treasurer and they compare that to the remittance list that they got from the mailroom. The two should be equal. If they're not equal, then some check didn't make it to the treasurer from the mailroom. Somebody in the mailroom kept a check, right? Or the treasurer has kept a check. Or they haven't, they've filled out a deposit slip with one check missing, right? So this guards as a control. The treasurer can't, lie on the deposit slip because the mailroom sends a remittance list to the controller, right? And so the remittance list and the deposit slip should line up, or somebody's lying. Somebody's messed up. And then the controller uses the total on the remittance list, and they're the ones that make the journal entry, debit cash, credit accounts receivable. They file the remittance list, the remittance advice, and the deposit slip. They keep a copy of those things. Now, what does the internal audit team do within the company? So the internal audit team, these are employees that are separate. They don't work in the treasurer's office, they don't work in the controller's office, and they don't work in the mailroom. What they do is they receive, at the end of each month, a bank statement from the company's bank. The company's bank, of course, is separate from the company. So they get the bank statement through the mail. It comes straight to the internal auditor. The treasurer doesn't get the bank statement. The controller doesn't get the bank statement. If they did get the bank statement first, they could like alter it a little bit, you know. So the bank statement comes straight to the internal audit, and the internal audit compares the bank statement with the stuff they got from the treasurer and the controller, right? They got a copy of the deposit slip from the treasurer, and they got a copy of the remittance list, the deposit slip, and the remittance advices from the controller. And so they just compare basically what does the company's the bank statement, which is made by the company's bank, all the cash inflows and outflows that happen in the company's account, does that match up with what happened within the company according to the treasurer and controller's offices? And so they prepare any deviations have to be summarized on the bank reconciliation. The bank reconciliation is the major quantitative part of this chapter. Most of the questions on exam 2 from chapter 7 will be bank reconciliation type questions, most of the quantitative questions. So we're going to teach you how to prepare a bank reconciliation. And then they'll prepare the internal audit will prepare the adjusting entries. So that's a summary of the control procedures that are in place to ensure that cash received on account is not misappropriated. All right. For the next thing is cash received from retail cash sales. What internal controls are in place to make sure that this cash isn't misappropriated? So you guys probably already kind of know this. There's a retail sales area. The sales associates use cash register to record the cash sales and to control and protect the cash collected from customers. Each sales associate has a unique password to identify themselves on the cash register. So we know when a given person starts working on that register and when they stop working. Each sales associate will begin each business day with a fixed amount of cash in their drawer. And the sales associate will enter the details of each sale into the cash register, right? Often they don't have to even, in the old days, they could have to do it by hand, but now, as soon as a sales associate swipes the customer's item over the bar scanner, because most retail sales areas have bar scanners now. As soon as they swipe that item over the bar scanner, it pops up on the sales associate screen, you know, the item and what the customer owes, the amount. So the sales associate doesn't have to enter anything in. For some items though, the sales associate does have to enter in. If you go to Walmart and you buy produce, often the produce doesn't have a barcode on it, and the sales associate has to weigh the item and also type in the quantity or something like that. And then but once they do that, then it automatically pops up the price that the customer owes. And so then the sales associate tells the customer what they owe. The customer gives the cash to the sales associate, and the sales associate puts the cash in the drawer. And the cash register obviously is keeping track of all the cash that the sales associate should have gotten. It's keeping track of what the customers owed the sales associate, right, for each item that was purchased. And so then at the end of the day, all you have to do, and the retail sales supervisor is the one that does it. They come in at the end of the day. They're the ones that oversee the retail sales operation, and they'll count the contents of each cash drawer. They'll compare the amount that's in the cash drawer. So the amount in the cash drawer at the end of the day should equal the amount that was there at the beginning of the day, plus whatever the register says was sold. And if it doesn't equal, then the retail sales supervisor will approach the sales associate and ask them, why are you short money? If it doesn't equal, of course, it's going to be unequal in one direction. It's going to be, there's going to be money short, right? It's not going to be extra money. Unless an employee, or unless a customer paid twice or paid more than they should have, but likely they wouldn't do that. So the retail sales supervisor, their main duty is to make sure that the cash in the drawer at the end of every day for each of their sales associates matches the beginning cash plus the total that the cash register says was bought that day by the customers at that register. And then their secondary duty is they do approve any unusual transactions. So a customer comes in to do merchandise return or something like that's an unusual transaction, they have to approve that. So these are their two functions essentially for the retail sales supervisor. So that basically describes the control, the internal controls in place to ensure that cash in the retail sale received in the retail sales environment isn't misappropriated or stolen. Also, once the retail sales supervisor, at the end of each day, they compare these things and make sure they actually prepare a written report of the sales and the cash received. They send the actual cash from the drawer and a copy of the written report to the treasurer. And then they send the cash register tape and a copy of the report to the controller. The cash register tape is just it's like you could print it out from the cash register. It's like a printout of all the things that were purchased that day by customers at that register. So that's a summary of the internal controls in place over cash received in a retail sales area. Definitely kind of know that in general. All right, the last thing in this chapter that we haven't really talked about is the bank reconciliation. Today I'll go into it a little bit. I'll give an overview of what a bank reconciliation is, but you still won't probably understand exactly what it is or how to prepare one until Thursday when I go over examples. You might get into one example today, I don't know. I haven't been looking to see if anyone has questions. Let me look and see if anyone has posted any questions. I don't know how to do that though. Maybe this way. I'm trying to look to see in the chat if anyone has posted a question. Oh well, I'll get back to it at the end if you do have a question. I'm still learning how to use this technology. Hold your question and I'll get to it at the end. All right, bank reconciliations. So the internal audit, the people in the internal audit office within a company, they're the ones that prepare the bank reconciliation. So what they do is they get a bank statement from the company's bank at the end of the month. And they compare that bank statement, essentially they compare that bank statement with the company's cash T account. The cash T account will have been, all the entries in the cash T account will have been made by the treasurer's office. Remember, they're the ones that are charged with recording. So the cash T account will have a balance as of the end of the month. The bank statement will say the company's bank account has a balance. And these two balances, so we'll call the bank statement balance the bank balance, and we'll call the cash T account balance the book balance. The bank balance and the book balance at the end of the month likely won't equal each other. Items such as outstanding checks, so checks the company has written, and they would already be recorded in the cash T account as a credit to cash, but the check hasn't reached the company, the intended person yet, and therefore they haven't taken it to their bank, and therefore it hasn't come, the money basically hasn't come out of your bank account yet. So outstanding checks would be in the books, but they wouldn't be on the bank, they wouldn't be reflected on the bank statement. Deposits in transit, these would be reflected in the books, but not on the bank statement. A deposit in transit is where the company has received money from a customer. They've received a check from a customer. they've debited cash and credited accounts receivable. So that shows up in the cash account. It's on the books. But they haven't taken the check yet to their bank. And therefore, it hasn't shown up on the bank statement. Maybe they got this check, on January 30th, and the bank statement is prepared as of January 31st. And as of January 31st, they haven't taken the check to the bank. They don't take it until February 2nd, so it wouldn't show up as a deposit in transit. That's another reason why there would be a difference between the book balance and the bank balance. So outstanding checks and deposits in transit, these are things that are already on the books, but not on the bank, not on the bank statement. Interest earned and bank fees, these are examples of things that are on the bank statement but aren't on the books. So obviously we might have earned interest in our checking account. We don't know what that interest is until we get the bank statement. Once we get the bank statement, then we can go put it on our books. A bank fee. Sometimes a bank will collect, say a company lends money to another company. So they have a note receivable. And often the company that does the lending, they won't collect the note themselves from the person they lended money to. They will have their bank collect the note for them on their behalf. And the bank, of course, will charge the company a fee for doing that, a small fee. So say I'm company A and I lend company B $300. My bank, company A's bank, will be in charge of collecting that note for me from company B. When they collect the note for me, right, $300 will show up in my account, but then my bank will charge me, say, $5 for doing that collection for me. So they'll take $5 out of my account as a bank fee. I won't know that fee until I see the bank statement. So once I see that, then I have to go, credit cash for $5 and debit usually miscellaneous expense for $5 for that fee. So these are examples of things that you have to reconcile: outstanding checks, deposits in transit, interest earned, and bank fees. But there are other examples as well that we're going to talk about. These are just a few of them. I'm not going to, you can read this. This is just self-explanatory. All right, proper control for cash includes each of the following except: bank reconciliations are a control for cash. They will let you know if cash is missing. Internal audits are a control for cash. The treasurer, they do act as custodian of the cash, and that's a control feature. The mailroom, however, doesn't record. They don't record the journal entry for the cash. That's done by the controller's office. So C isn't right. All right. So that's all the PowerPoints go into in terms of bank reconciliations. They didn't even do bank reconciliation justice. So I'll talk a little more about bank reconciliations right now. Appendix 7A, you're not responsible for on the exam, so we won't go over that. Don't worry about Appendix 7A. You're only responsible for the main chapter 7. So let's go into a little more detail in regards to bank reconciliations, and then we'll be done with this lecture. Let's just go to the book. And I know you guys can do this yourselves, but I feel like I can help you understand it a little better. So at the end of each month, a company will receive a bank statement from their bank. And let's give an example here. Wilson Corporation receives this bank statement at the end of November from their bank. Their bank is Anchor National Bank. Doesn't matter who their bank is. They receive this bank statement from their bank. On the bank statement, we see all the deposits into Wilson's account. and all deposits and credits to Wilson's account. And we see all so these are all the things that came into Wilson's account, the deposits and credits. And the checks and debits, the checks and debits are all the things that came out of Wilson's account. Remember, in bank terminology, a credit increases your account and a debit decreases your account in terms of your cash. That's the bank terminology. We know in financial accounting, debit and credit have different meanings, right? But when you see the bank statement, deposits and credits, these are all the things that increase your account, that come into your account. And checks and debits are things that leave your, there are decreases in your account. And then over here in this far column on the right, we have the daily balance. At the end of each day, that's the balance of your account. So we want to pay attention to this final balance on November 30th, at the end of the month. This is what's known as the bank balance. The bank balance, the bank says we have $6,488.95 in our cash account. We want to compare that to what our cash T account balance is in our cash T account. That's our book balance. So our book balance is whatever the cash T account says. They're going to be different. They're not going to be the same. And the bank reconciliation is going to reconcile these two numbers. All right. On the bank statement, there are a couple things to look at. Down here, item codes. EC means error correction. So if the bank made an error, then they would fix the error and they would have EC beside it. In this particular example, there aren't any error corrections. You don't see any ECs. Then we have BM, debit memo. You see this right here, a debit memo November 26th. A debit memo, this means the bank is taking money out of your account and charging you for some service that they did for you. And we know in this example, the bank for Wilson has collected a note receivable. They collected a $300 note receivable for Wilson. And then they charged Wilson a $5 fee for doing so. So that CM up there, that's a credit memo. The bank has collected. Credit memo means a bank is collecting on the company's behalf. Debit memo means they're charging the company for doing that collection, charging them a small fee. And then RT is return item. Trying to think what that would be. This is essentially very similar. You can just think of this as a NSF check. A not sufficient funds check is a check that a customer of Wilson Corporation has written to Wilson Corporation to pay off their account. Wilson has debited cash and credited that customer's account receivable. But then when Wilson looks at the bank statement, they see, oh, that customer did not have enough money in their bank account to cover that check. They didn't have the money in that account. So that would show up right here as a debit memo, as a debit to Wilson's bank account. The bank is taking the money out. It would have put it in over here. No, it's letting Wilson know that that check, the customer didn't have the money to clear. So that's what a not sufficient funds check is. And that's similar to a returned item. You can just think of it like that. And then service, SC service charge, $10. This is just a charge that the bank is charging Wilson Corporation for Wilson doing business with the bank. It's just some service charge. Just a charge by the bank to the company. It could be for maintaining the company's lockbox. You know, when you bank with a bank, you can have a lockbox at that bank, which is a physical box that you can go and put really important items in. Take, for example, the company Kentucky Fried Chicken. Their bank has a lockbox And in that lockbox, Kentucky Fried Chicken puts the recipe for their chicken. They want to keep that under complete control. They don't want anybody getting it or stealing it. So they likely will have a lockbox with their bank, and the bank will keep the recipe in that lockbox. The physical recipe is in the lockbox. And the bank will charge KFC a service charge each month for doing that, like $10 a month. That's what a service charge is. Overdraft, it's a charge. There are no overdrafts here, but it's a charge by the bank to the company because the company overdrew their account. They wrote a check for more money than they had in their account. And the overdraft is just the fee that the bank charges the company for doing that. It's like the slap on the hand. You won't see overdraft very often for companies, right? They don't overdraw their account. So don't worry about overdraft. All right. Let's look at the structure of the bank reconciliation. So bank reconciliation has two columns. First column would be you start with the ending balance on the bank statement, so the bank balance. Second column, you start with the ending balance in the cash T account. And then you make adjustments to the bank balance first, and then you make adjustments to the book balance second. After you've made those adjustments, the adjusted bank balance and the adjusted book balance should be equal. And that's how you check yourself to see if you did the reconciliation right. All right, what adjustments do you make to the bank balance? To the bank balance, you add deposits in transit. So these are checks that customers have written the company, but it hasn't cleared the company's bank yet. You've already recorded these checks in the cash T account, but they're not on the bank statement because they haven't gotten to your bank yet by the end of the month. So deposits in transit. Add that to the bank balance. I mean, you really have that money, but you really do have that money. The check's in the mail, or you've received the check and you just haven't taken it to the bank yet. So you really have it. It just hasn't shown up. It's not in your ending your bank balance number yet. Then you want to subtract from the bank balance any outstanding checks. Any checks that you've written, that you've written, so you've already credited cash for them and debited accounts payable. So you're paying off an account with your supplier. So checks that you've written but haven't cleared the other person's bank yet. So they're not on your bank statement. Until they clear their bank, it's not on your bank statement. Right? You know how this works. You write a check and then you give it to someone. They take the check to their bank. Their bank contacts your bank and takes the money out of your bank and puts it in their bank. That's how it works. So outstanding checks are checks that the person that you wrote the check to, they still have it. They haven't given it to their bank yet. Therefore, it hasn't shown up on your bank statement. So that's essentially what you do to the bank balance. You just add deposits in transit and you subtract outstanding checks. To the book balance, that's what you usually have to do more to the book balance to reconcile. So you would add any item recorded as a cash receipt by the bank, but not yet recorded in the company's account, cash account. What would an item be? An example, like a note receivable. The bank collects for the company. The company doesn't know the bank collected it until they get the bank statement. So it's definitely not in their cash balance yet. And then once they see it on the bank statement, they have to add it. Debit, cash, credit, notes receivable. And then of course, subtract any items that are recorded as cash disbursements by the bank, but you haven't recorded it in your cash account yet. What are examples of items like that? An example will be that service charge. Interest actually be an addition. You get interest. Service charge is the charge the bank charges you for doing a service for you, like maintaining a lockbox, like we talked about. Not sufficient funds check, also is a subtraction from the book balance, right? This shows up, the bank's letting us know, hey, that check that you thought that you received from the customer, so you would have debited cash up here for the check amount, and you would have credited accounts receivable, but then you find out the customer didn't have that cash to cover the check in their bank account. So when you see that, you have to go subtract it back from your book balance. You really didn't get that cash. You thought you did, but you didn't. So that not sufficient funds check trips up students the most. That's the one, because they don't know what it means. They don't know. Does it mean that the company wrote a check and they didn't have enough money in their account? No, that's not sufficient funds. Not sufficient funds check is always a check written by a customer to the company, and that customer didn't have the money in their account. So once you add these things and subtract these things from the book balance, then you get the reconciled book balance, and it should be equal to the reconciled bank balance. So let's do the bank reconciliation for Wilson, and then we'll be done for today. So the internal auditor of Wilson Corporation, they get the bank statement from Wilson's bank, and they're preparing the bank reconciliation for the month of November. So the ending bank balance on the bank statement, $64,8895. You remember that number from the bank statement right here. It's the ending balance. The bank says we have this much in our account at the end of the month. So that's the bank. That's the unadjusted bank balance. And then the ending balance that are in our cash T account, the unadjusted book balance, 5,322.69, and they don't equal each other. So we prepare a bank reconciliation. 2 columns. First column starts with the unadjusted bank balance, and to that we make adjustments. What adjustments do we make? We're first going to add deposits in transit, then we're going to subtract outstanding checks. So we got to go find out what are the deposits in transit. So it says any item on the previous bank reconciliation that has any items that have still not been processed by the bank must appear on the current bank reconciliation. The October 31st reconciliation included the following: a $420 deposit in transit on the previous month's bank reconciliation, and then 3 outstanding checks. If we look on the November 30th bank statement, it includes the $420 deposit. It was the first deposit made in November. That hadn't been made as of the end of October, and that's why that was on the October bank reconciliation. But now in November, it's made. So it was a deposit in transit as of the end of October, but it's no longer a deposit in transit as of the end of November because it's already in our account. And then outstanding checks. These 3 checks were outstanding in October. Do these 3 checks show up on our November bank statement? If they do, we don't have to do anything for them. They're already there. Let's see, what are the 3 checks? Check number 149, 154, and 155. Check number 154, 155, and what was the other one? So I see 154, 155. Oh, and 149. Oh, these are checks we've written, sorry. Yeah, 149 is right there, 154 and 155. Those 3 checks cleared our bank. So those aren't outstanding checks as of the end of November. They were outstanding as of the end of October. So we first check the October outstanding checks and deposits in transit and make sure that they're not still outstanding as of the end of November. That's the first step. And then after that, now we compare the deposits made during the month to the deposits on the bank statement. So that they would have to give you this information. This is given. The Wilson Corporation made the following deposits during November. So they made all these deposits. Do all these deposits appear on the November bank statement? One of them may not appear because when it says they made the following deposits, that means they brought the check over to their bank, but that doesn't mean the bank processed it yet. So checks that they brought over towards the end of the month may not be processed yet. These ones at the beginning and the middle of the month, those should be all on our bank statement because the bank would have processed them by now. So we're just checking for all these things. It says here, all these deposits appear on the bank statement except for the November 30th deposit of $225. So that's a deposit in transit. We go to the bank statement. You will see all those deposits here except for you don't see $225. So that's an amount that we've already, it's already in our cash T account. And we took the check to our bank, but the bank, it hasn't shown up on our bank statement yet. So we need to add that to our bank, unadjusted bank balance. Add deposits in transit. So we'll add $225. That's the first thing we'll do to this $6488.95. Add $225. And then we need to go see, are there any outstanding checks? Compare the checks issued during the month to the checks in the bank statement. These are the checks we wrote this month. Do all these checks appear on our November bank statement? It says here, 4 of the checks, number 167, 168, 172, and 173, do not appear on the bank statement. So we literally have to go and for each of these checks, see if we can see it on the bank statement. If we don't see it, that's an outstanding check. It's a check we've written, we've recorded it in our cash account, but it hasn't cleared our bank yet. Why has it not cleared our bank yet? Maybe the person we wrote the check to, they still have it in their pocket and they haven't taken it to their bank. Therefore, it hasn't cleared our bank yet. Therefore, it's not on our bank statement. So if you compare each of these checks to the bank statement, you'll see 167, 168, 172, and 173 are not on the bank statement. So 301.66, $149.50, $450, and $240.50. Those are all the outstanding checks. So we're going to subtract those from our bank balance. So to summarize, so here's our bank reconciliation. We start left-hand side, we start with our unadjusted bank balance. We add the deposit in transit. Then we subtract those outstanding checks. And that gives us an adjusted bank balance of $5572.29. We don't have to make any more adjustments to the bank side. Now next, we start with the book balance. And then we make adjustments to the book balance. So let's see, what was the book balance start? Well, here it said the book balance at the end of the month, 5,322.69. I think that's a typo, because that's the number we should start with on our bank reconciliation for the book balance. It's the unadjusted book balance. But they didn't start with that number. They started with this number. So that's a typo. Don't know why that's in the book. So this is the balance on our books for our cash T account as of the end of November before any adjustment. And then we have to make adjustments. What adjustments do we make? It tells us about those in 4 and 5. So we scan the bank statement for any charges or credits that are not yet reflected in our cash account. So if we look at the bank statement, there's a $35.40 charge for a returned item. So we subtract $35.40 right here. That's the NSF check I was talking about. It's a check written to us by a customer. We would have already recorded it by debiting cash and crediting their account receivable. But then the bank is telling us they didn't have the money in their account to cover it. So now we have to subtract it away. We have to credit cash and debit accounts receivable. So we have to subtract it from our unadjusted bank balance in cash. That's where that check is. Then that $10 service charge that the bank charges us, we subtract that as well. And then what do we add? We have to add the note The bank collected $300 note for us, but subtract the fee. They charged a $5 fee for collecting it, right? If we go back to the bank statement, there's the $300 note they collected, and then there's the $5 fee they charged us for collecting that note, right there. And then finally, there's one other adjustment we need to make to the book balance, and it has to do with an error. And it tells us right here, the Wilson Corporation recorded check number 159 as $725, but the check was written for $275. The check was written to pay for office supplies. So Wilson wrote a check for $275, and that was what they paid for office supplies. But then whenever they recorded in the cash account, they credited cash for $725, not $275. They did a transposition. You see, they just transposed the 2 and the 7. So they credited cash for $725. So they credited cash for $450 too much. $450 too much. So then now they got to go back and add $450 to their cash balance, because they really have $450 more than they thought they did. See, so they add the $450 here. And after making all these adjustments, you can see the adjusted cash balance on the book side is equal to the adjusted bank balance, the adjusted cash balance on the bank side. So our bank reconciliation is correct. Another thing I want to point out here, and then I'm going to be done. I'll ask for questions and then I'll be done, is these errors. There's one thing you can do. You see, this is a transposition error. They should have recorded 725, or I'm sorry, they should have recorded 275, because that's what they wrote the check for. But they recorded 725. They just transposed the 7 and the 2. Look at what the error is. The difference between 725 and 275 is $450. And that error, 450, it's a multiple of 9. When you divide it by 9, you get an integer. One thing about transposition errors, it's a mathematical fact. A transposition error is always a multiple of 9. And that's how lots of errors are caught. Transposition errors are pretty common in accounting, and they're always a multiple of 9. So if you see, if you're after doing, let's go to your bank. After doing your reconciliation here, and you get your adjusted book balance, and then over here on the bank side, you do all the reconciliation that you think you need to do, and you get your adjusted bank balance, and the difference between these two numbers is a multiple of 9. Then there's likely some transposition error that you've not caught, and the error has to be either added or subtracted over here on the book side, right? What if they let's go back to the error. What if instead of and so they wrote the check for 275, but say they recorded it for 257. So the difference between 275 and 257, they recorded they recorded that they only spent 257, but they really spent 275, $18 more, right? 18 divided by 9 is 2. It's a multiple of 9. A number is a multiple of 9. If you divide that number by 9, you get an even number, or you get you get an integer. So the error, the 275 minus 257, $18, is a multiple of 9, and it's a transposition error. And we would need to go subtract an additional $18 from the book side, right? We should have subtracted 275. We only subtracted 257. So we'd have to go subtract that error. In this case, we have to add the error because what we recorded that we wrote the check for is more than what we actually wrote the check for. All right. I'm going to stop sharing my screen, and I don't see anybody typing in the chat that they have a question. So if anybody has a question, you can unmute your mic and ask it now. And if you don't, I will continue this on Thursday with several examples of doing bank reconciliations from the end of chapter 7. So does anyone have a question? No questions? Okay. Someone does have a question. Online lecture. I don't know exactly what the question is. I'm going to post this lecture on Blackboard as soon as we get done. Like same as today. Yeah, I'll post this lecture on Blackboard so you can watch it again. Thank you, Junelle. And then Thursday we'll have a lecture just like today, and I will send you guys a link via email, just like I did for this lecture, so that you can attend the lecture on Thursday. It'll be just like today. You're welcome, Madeline. Take care. Are there any other questions? I hope this, thank you, Janelle. I hope this worked well for you all. And I hope you guys can keep up with the material in this online setting. If you guys have any questions or you want to meet with me, we can meet in Zoom anytime you want. Just email me the time you want to meet and we can have a one-on-one meeting. If you want to talk about anything about the course or you have any questions over anything, just let me know. And if there aren't any more questions, I will end the lecture now. Thank you all.